Super excited to have Clint Coons on this call. He and I connected a couple of weeks ago, and he's doing tons and tons of really, really cool things. He has awesome experience in real estate investing, accounting, and taxes. So I wanted to bring him on this call. And, as we're getting closer to the tax filing deadline, I want to bring him on the call and share some of the best practices that he's noticed in his experience for real estate investors. So welcome, Clint. How are you? My name is Sharad. I'm the owner and founder of REsimpli. Welcome to our weekly mastermind call. Super excited to have Clint Coons on this call. He and I connected a couple of weeks ago, and he's doing tons and tons of really, really cool things. And, he has awesome experience in real estate investing, accounting, and taxes. So I wanted to bring him on this call. And, as we're getting closer to the tax filing deadline, I want to bring him on the call and share some of the best practices that he's noticed in his experience for real estate investors. So welcome, Clint. How are you?
I'm doing well. Thanks for having me on.
Yeah, absolutely, man. Thank you so much for coming on the call. I'm super, super excited. I know I was reading your bio. I know you're doing a lot of really cool things. So if you can just share a little bit about your background, I think it'll be cool just to set the stage, and then, we'll just jump right into the Q&A if that works.
That works. Yeah, I am an attorney, but I really view myself as a real estate investor. So my background is I started Anderson with my partner, Toby Mathis, back in '99. We started with about, after a year, we had 30 employees, and we've since grown the firm to 500 employees with offices in Washington, Nevada, Wyoming, and Utah. And what's unique about our firm from the standpoint of how we operate with investors is that we bring both the legal and the tax together. So it's a one-stop shop. So people are working with us, if they're talking about cost seg, if you're talking about wholesaling or flipping real estate, the professionals that you speak to on either the tax or the legal side, they understand what you're doing. And because they're operating together for the benefit of the client. But what really makes us stand out here at Anderson is that my background is real estate investing. My partner's background is real estate investing. And so are that of many of the people, strategists that work for us. My portfolio is quite extensive. I have real estate in multiple states, close to 600 doors, over 300 properties. I flip real estate. I have an active flipping operation going on in Winston, North Carolina, Winston-Salem. Commercial, multifamily, single family, and self-storage and warehouses, and you name it. There's some things I'm forgetting there, mobile homes. That's really what I do is the real estate. And I've seen what it can do for wealth generation. So I'm really passionate about it.
Yeah, I absolutely love that about you, because, you're not just like you're bringing in you're not just bringing in an outside, perspective from just an attorney or, someone with accounting background. You're actually doing investing yourself. You're a very, very active investor yourself. So I love that. I'm excited about the call. All right, guys. So I'm going to be asking Clint questions. If you guys have any questions, either you can put it in the chat or feel free to unmute yourself and then ask the question. So Clint, the first question I want to start out with is, what is the best entity structure that you recommend for real estate investors? And does it differ for someone that's doing flipping versus someone that's doing wholesaling or buy and hold?
Well, yeah, that's the biggest misconception, is that real estate investing is, when it comes to asset protection, it's a one size fits all. And it truly isn't. I tell people that when you're thinking about investing and creating a business, the way I look at it is a three-legged stool. You have asset protection as one leg. You have tax planning as a second leg of that stool. And that third leg is what we refer to as business planning. And if you're going to start investing, you need to look at it as a business. And whatever you put into effect to help you grow your investing needs to take into consideration all three of those. For example, if you went to a local attorney and you asked, what should I set up? That attorney will probably tell you, if you're flipping real estate, wholesaling real estate, or just buy and hold, create a limited liability company. And if you went to the CPA and you said, I'm holding real estate, they'll probably tell you, treat it as a disregarded entity, maybe a partnership. Or if you're flipping, an S corp. But then there's that other side, the business planning leg. If you start talking to them, you say, well, how am I going to look better to lenders if I want to go out and borrow money? And they're probably not going to understand how the entities in your tax returns can impact your ability to borrow, which is then can impact your ability to scale. So your question, depending on what I'm doing, is really going to be dependent based upon where you want to take your business. So if you want to get a little more granular, if I was going to flip real estate or wholesale real estate, then I'm usually going to use either a limited liability company treated as an S or a C corp for federal tax purposes, or I'm going to use a traditional Inc. corporation treated as a C or S. And those two decisions are driven more so by the investment the individual investor is making to get their business set up. And then if you're buy and hold, then now it's all over the board. I mean, typically it's going to be an LLC, or it could be a Wyoming statutory trust if you live in California and you want to avoid the $800 a year franchise tax. Or if you're investing in Tennessee, maybe it's a land trust back to an LLC, or Florida is going to be land trust. And those buy and hold investors, how do you source your properties? Are you sourcing your properties because you're throwing the leads out like what your system is designed to do to attract individuals, or are you going to auctions? And so depending on how you source your properties, we're going to come up with a different strategy for that as well, using different tools. And so what we try to do is develop an approach for our clientele that is specific to not only the type of investing they're engaging in, but where they're investing. Because every state, well, not every state, but a lot of states have some nuances that you should be aware of.
Right. Yeah. I mean, I invest in Indiana, and you mentioned about Tennessee, I believe. So the way I have my structure set up is every property that we buy it in a separate land trust of its own. It's very easy to set up a land trust. We don't have to file the document anywhere. And then all of the land trust do I have, depending on whether if I'm going to flip a property, I'm going to keep it as a rental. The beneficiary of that trust is an LLC. If it's a rental, it's a separate LLC. If it's a house flipping, then it's a separate LLC. And then I use my LLC as the operating entity for all the trusts that I have. And when we sell a property, everything is done under that trust. And then for the EIN number purposes, we use the EIN for LLC. Is that the right approach to do? I mean, again, I'm investing in Indiana, but I'm moving to California in about 4 months there. So I think that might change things a little bit for me.
Change a little bit there. Yeah. Mind if I share out a screen?
Yeah, go ahead.
Here's your entity. This is going to be a corporation. Could be an LLC, taxes an S or C. It doesn't matter. But the idea is this is your base entity. Now, when you acquire a property, right? The question is, am I going to flip this property? Am I going to wholesale this property, or am I going to keep this property? Many times, I mean, I've done the same thing with my business. I buy 18 homes with the intention of flipping them, and I get in there and I start doing the rehab work. I'm like, well, you know what? I want to keep 3 of these for myself. So I'm going to carve those out and I'll flip the other 15. So by buying them in a land trust, and I like doing this because, as you stated, the land trusts are easy. You just set them up. Many times you just name them after the property address. You have the land trust created, and the corp is the beneficiary of that trust. Now, I'll take it one step further. I will use a limited liability company. I'll set this one up in Wyoming, and I'll make that the trustee of my land trust. And the reason why is I want anonymity. I don't want people to know that trust is tied back to me, because they can't see the beneficiary because the trust isn't recorded anywhere. The only entity on title, or two individuals on title, would be the trust name and the trustee. So I have a choice. I could take title of this property as Clint Coons, trustee, of GB Trust, or I could create this LLC, and the LLC is, Funky Town LLC, trustee of the GB Trust. So by using the LLC, if someone were to look up the Funky Town Limited Liability Company, it's a Wyoming LLC. It doesn't point back to me because they don't collect any information. So I like that privacy aspect of how I put deals together by using that trustee there. But the benefit of using the land trust in this situation is, threefold. One of the concerns that you can run into sometimes with sellers is that if you're going to wholesale this deal, And if you're out there marketing it and they find out about it, they get wind about it, they could walk away and just sell it to someone else. I have a client right in Texas right now. We set up a structure just like this. He takes title in land. He wasn't using land trust, but he was doing it in his corporation. Well, seller found out he was trying to wholesale it and he wasn't going to close. So the individual turned around and sold it to someone else because he realized there was some extra profit there. And so now he's left with this option. What do I do? Sue? I said, yeah, it's going to be expensive. So I like the anonymity aspect here, because by taking in the land trust, they don't know who's involved, and maybe you're marketing it through your corporation. They're not going to see that. The seller wouldn't necessarily see that. The other thing is, let's assume that you're in a state or with that contract that doesn't allow you to assign the interest. Maybe you didn't put in there and or designated entity when you entered into the purchase and sale agreement. So with a land trust, you don't have to worry about any of that any longer, because if I wanted to wholesale this deal and here's my investor, I just kick them the trust. They just take over the trust. Now they have it. I resign as trustee. They become the trustee, and then they're in control of that property, because the property will close in the name of the trust. Now, if I didn't want to do that and I wanted to keep this deal as my own, put it part of my portfolio. So in my portfolio, the way I've set it up, I have a second Wyoming LLC over here that has state specific. So I have Indiana LLCs because I also own real estate in Indianapolis. My portfolio there, I think, is 12 properties. I think I have in that area. So I have LLCs set up. What I'll do is I will assign, it's just a piece of paper. I just transfer the beneficial interest over to the LLC. And now it's no longer, this land trust is no longer held by my corp. It's held by this Indiana limited liability company. And then if I determined later, I sat back and I looked at this LLC and I thought, you know what? I don't want this property in this limited liability company anymore. I want to move it out. I could just assign the interest again over to another company. And every time I assign this interest, no one knows where that trust sits because it's not recorded anywhere. Title's in the name of the trust, but who owns the trust? That's all private. Now, if I decided to flip the deal, so if this property, I'm not doing any of this, I'm just going to flip it, I rehab it, and I flip the property. Well, then on my deals, when I go to closing, what I'll typically do with the trust itself, I haven't opened a bank account, which I don't tend to open up bank accounts for my land trust, just because I have so many accounts then I would have to deal with. I will, depend on your title company, I'll typically file a DBA for this entity here using this trust name. That way, when title, I'll ask for a physical check. They'll send me a physical check at closing, and then I can go down to my entity and just deposit it into the entity. So this entity will have multiple DBAs associated with it, just for purposes of negotiating those checks. If you don't want to sit there and open up a separate bank account. So there's a lot of ways to do it, but that's just, I'm giving you a sense of how I've done it personally and how I work with our clients as well.
Yeah, I think this is really, really cool. So you're right. I mean, the way I have my entity, my structure set up is I am the trustee. And then we had recently, just like 2 or 3 weeks ago, we sold a property. And then most of the time we don't have this issue where we give them the wiring instructions for my LLC and they would wire the money. But every now and then we've had this issue where the name on the deed, which is the trust, doesn't match with, where I'm wiring the money. So they would actually send me a physical check and it has my name on it. So I've had to deposit it in my personal account. And once the check clears, then I move it into my business account. I love this approach of having the LLC as the trustee. Then this way I can have a separate bank account set up so it never actually goes through my personal bank account. So I think that's really, and I just want to make sure that everybody on the call picked it up. What Clint mentioned about, if you are in a state where they don't allow assignment, Clint, if you can go over that where, you mentioned, I think that was a very, very, very cool idea you can actually assign over or give ownership of the land trust to the individual that you want to sell the property. So if you can go over that, I think that's a really, really great idea, especially if some of the states are cracking down on assignment of a contract.
Yeah. So with assignment of contracts, they want individual wholesalers to become licensed, right? Because they say you're engaging in the a realtor activity. So now you got to be licensed as a realtor. So that's an issue. The second issue that comes up is in the context of the purchase and sale agreement. If a seller or even say they're represented by an agent, if this wasn't off market, see that language and or designated entity in there. If you put that in your REPSA, then they may come back and say, well, we're not comfortable with that. So, or excuse me, and or assigns. That's why I always put in and or designated entity. But then the problem with using any type of language like that is as you're working with more investors or sellers, what I've found sometimes is that they see that type of language, and or assigns, and or designated entity in the name, in the offer name. So maybe you put in your company name and or designated entity, so you can transfer that agreement to someone else, and the seller's put on notice. They may not be willing to sell you. I just lost a deal last year because the seller saw that language in my agreement that I presented to them. And they said, oh, no, this is just someone who's trying to profit off this. They're just going to flip it and make money. I'm going to hold on to it. I'm going to get my price that I want to get out of this deal. So by using the land trust, you avoid some of those issues because you're not having to put in there and or assigns and or designated entity, or put an assignment clause in there, or a novation clause in your purchase and sale agreement. All those things, could be triggers for the seller to walk away or back away from that offer. By putting the name of the trust is locking it down. And now you're no longer wholesaling a piece of property. You're no longer assigning a piece of property or a contract to a investor. What you're doing is you're selling them your trust interest, your beneficial interest. I'm transferring you this interest. And where I first got started using this technique with these trusts is back in 2008, where I had clients that were bidding on HUD homes, and they were trying to wholesale HUD homes, but they couldn't do it because HUD does not allow you to assign the contract. You have to close. If you make the offer in your name, you'd have to do a double close in order to bring an investor in. Well, my clients didn't want to go through a double close. So what we started doing for those investors that were buying through HUD is we created trusts. And I created a land trust. And since I've modified it, now I call it a wholesale trust because it has a few different provisions in there than a typical land trust. But it's designed to do the same thing. You just transfer it over and you avoid a lot of those objections that come up.
That's awesome. No, I think that's a really, really great idea. I remember some other investors in the market, they were doing something similar. And then also HUD Homes has this, I don't know if they still do, but you could not sell a property within 90 days for more than 120% of the purchase price. Yep. So this is another way of, this is another loophole that you can use. So really cool idea. So Sue has a question. Can all entities for each type of investing, fix and flip, buy and hold, wholesale be put under one holding company? Or would you have separate holding companies for different entity types, investing types?
Yeah, I have one. Well, I break mine apart. So on my side, I have a holding company here that holds all my real estate interests like this. All my real estate LLCs flow into this one. Syndications, the exact same thing. They flow into here. So this is all real estate. And then I have a separate entity over here that I call it my banking. So this is where I put all my cash. So I'm sitting down here, I take distributions out of here and I move it up into here. Why do I do that? Just for safety reasons. I don't want to accumulate a lot of cash here in this entity in case someone were to pierce the veil of an LLC and then get down into here, then they would have access to those funds. So I'm constantly stripping my money every 3 to 4 months, I'll pull out the cash and move it over here to my banking entity. On the flipping side, it's a different structure. So on the flipping side, it's an LLC that flows down here into another entity. This one's taxed as an S or C typically for our clients. I prefer C corporations, but this is a tax entity, but this is the entity we do all the flips through here, up here. And so by doing it this way, we give this one anonymity. Again, I just don't want people knowing that it's me in the market. And they have a sense for who the actual owner is of that entity. I prefer to have my privacy with my real estate dealings. And so, I have people that work for that company and they're my representatives, but I don't want, and I also use this as my PM in Winston-Salem for all my properties there. I don't want those tenants looking back through that and seeing me. So I actually use 3. One other thing I forgot to mention that you just brought up, we were talking about the land trust. If you're flipping property, another benefit of using the land trust, as I'm sure you already know as well, is that when you sell that property, if you're selling that property under Freddie, Fannie, and it's a first-time home buyer and they're qualified on one of those programs, a lot of times you have seasoning requirements that you want to meet. And so by keeping it in the land trust, depending on where that goes, maybe it's just right going to an investor who's going to do the rehab work. So maybe you're flipping it to an investor, then the investor sells to the homeowner. Well, I want to make sure that my investors that I work with, there's not going to be, 2 turns in the chain of title, which will throw off the ability of their buyer to qualify. So by keeping it in one entity, you can satisfy the seasoning requirements that Freddie and Fannie will impose on many home buyers who are coming under those special programs that they have. Typically, the seasoning requirements are 6 months for an individual or anybody that's selling property, because they want to make sure that the property is not artificially inflated, that it's, somebody just did a rehab work and they flipped it a few times and now it's being sold for more than it is. So that's something to consider as well in using the land trust seasoning.
Got it. So let's say if I bought a property in my land trust on Jan 1st of this year, and then, let's say today, April 21st to 22nd, whatever it is, I just transfer the ownership of my land trust to another investor who wants to rehab it and flip it, the seasoning would start Jan 1st.
Correct. The seasoning starts the day you take title. And
Right.
Yeah, and work with people who do that, who flip to investors, that becomes a problem if they're turning around selling to homeowners and they're trying to qualify under some of those Freddie Fannie special programs they have. And then they got that they have that seasoning provision built into the lending.
I'm curious. So if, the clients that you're helping them with this sort of, transfer of ownership, are you going through an escrow company, title company, or you're just like, it's a quit claim deed or something similar to that, where you're just essentially like transferring your ownership of the entity to another person, or are you pulling, checking the deed or any liens at that point?
Yeah, so I represent the people who are always transferring, not necessarily. We have many people that are on the recipient side of this, although we just had one situation come up the other day where somebody was working, happened to be one of our existing clients as well, and they were buying 9 land trusts from them. And so when you're doing that, you're right. You want to go in and get another title policy to back it up, just to make sure that you're receiving clear title and there aren't any liens or encumbrances that have been entered against that property since the time they took ownership. That's always advisable if you're buying that property. But as far as the mechanics are concerned, what you have to do, if I'm say you're flipping me the land trust, I'm the investor. First off, if you set this up here and you're using Wyoming LLC here as the trustee of this land trust, and here's the individual owner of it. If my client's coming in and they're going to buy that interest, okay, I'm going to tell them this. We need to get an assignment, okay, from the current owner to my client, the assignment of beneficial interest. I also need them to provide me a trustee's deed, okay? because I need this entity here to resign as trustee. So the entity resigns as trustee, and myself or my entity as the buyer will be appointed as the successor trustee. But I need a trustee's deed. And this is critical if you use land trusts. When you're transferring a trust, if you're the recipient, or if you're not the recipient and you're transferring it to another party, you have to provide a trustee's deed or receive a trustee's deed, because that is what gives the buyer the ability to substitute out you, your entity, or their entity, or themselves as an individual, if they're going to be the individual trustee. Okay, you want to get off there. Or if I'm coming in, I want you off of there. So when I record that trustee's deed, it'll take out Funky Town up here and put down here, Red Rabbit. That was the name of it, LLC. So that'll show up on title. So then now I'm in control. And the thing is that when you're transferring, you want to be off as trustee. You don't want to be there. There was a number of years ago, I just started practicing. There was this elderly couple that came over, drove all the way over from Spokane, Washington to Seattle, where I first started my practice. And they sat down with me and they wanted to create all these land trusts and move all their real estate into land trusts. And they wanted me to serve as their trustee, which I've done this for a lot of clients. I'm easily on over 10,000 pieces of property where I'm listed as a trustee. And then I resign my position and my clients take over. And they do that because they want the attorney standing there for attorney-client privilege to make it even more difficult. Come to find out, make a long story short, this couple that had all this property and they were making tons of money from their farmland, turns out they were growing marijuana in the basement of all their rental properties. And the reason we found out is because it was the largest drug bust in the state of Washington at the time, because every single one of the rental properties in Idaho, 80-some-year-old guy, he had grow operations in all these places. Now, I dodged a bullet. Had I been a trustee listed on those properties, that would have probably drug me in somehow and had somebody trying to figure out, well, what's this attorney doing? So that's why you always want to get off there on those deals, resign, give them a trustee's deed.
That makes sense. Cool. Yeah. No, that's super helpful. David said, wow, this is cool. I follow his YouTube account. So Clint, you have some fans over here.
Oh, right.
One David says this call will be recorded and it'll be available on our Facebook group. It's being streamed live, and we'll send a recording in an email also. Raj has a question. New investors may not have funds to invest in engaging an entity planner. What is the best guidance for a small investor like me to start the entity structure so that when I grow, have funds and ready to invest to engage an entity planner like yourself, we don't bring a messed up structure? I think that's a great question. So any thoughts on that, Clint?
Well, it depends on what type of investing you're engaging in. You're going to start out and you're going to flip property, wholesale property, doesn't matter what you're doing. Get yourself on that side, flipping or wholesaling, get yourself an LLC set up. Even though, you set this up and it may not have what I would recommend you have in there, it's better than nothing. Go down to the state in which you're doing the activity and don't worry about anonymity, none of that stuff. All right, because that's the problem that I see time and time again. People, they see me on YouTube, they come to my events and they hear me talk about it. And I say, these are the things you need to be doing. And if you don't, here are the problems that are going to arise. And I'm telling you that based upon experience and working with people. But if you're at that point, you're thinking, I just don't have the $2,500 to set this up the way he's suggesting, but I can scrape together two. Well, then get two, get it filed, and at least start operating on there to create some shield for yourself. And then as soon as you have that opportunity, you do your first deal and you got some cash, then get it done right. Because one problem that can arise is that you start finding success and you keep using a structure that is not optimized to what you're doing. And so far you get down the road and you realize, oh, I've overpaid in taxes. My name's associated with all of this. I built this brand now. And now my brand is really been put at risk by the way I've been conducting my business. And you end up in a lawsuit. And then you come back and you say, what do I do? That's a tough position for us to help at that point in time. So start with an entity, best strategy. If you can't even set up an entity right now, maybe you make your offers in the name of a trust. Use a land trust, because those can be simple. You don't have to make it complicated, and just start building from there. But I really think after you do your first deal and you get that first paycheck, that's when you need to invest in your business, because it's going to help you do more.
That's awesome. I have a question for you, Clint. So let's say, you mentioned you have about 12, 15 properties in Indianapolis, right? And then you have them in a trust, and then the LLC is the beneficiary of the trust, right? Of all the trust. Do you cap number of LLCs or properties based on the equity that you have? You're laughing, so I'm sure you've been asked this question a few times. Is it based on number of properties, or do you cap it based on the equity? Or you don't do that because, like you have a layer of trust with LLC protection. And then in your case, you have the trustee is also a Wyoming LLC, then you don't even care about that.
A great question. And I'm smiling because I was wondering, well, that's a softball. I love that question. It really exemplifies, the thinking around asset protection. And I used to make this mistake that I would tell people, look at the equity, right? So if you were buying properties, I would say have put into this LLC no more than 5 properties up to about $400,000 in equity. So maybe that's 4 properties you drop into this one limited liability company. And, I even in my first book, I stated this is what you should do. And this is our approach. When I first started out and I was advising people, I was focusing on this here, the equity, because if something goes wrong with one of these properties, assume each of them have $100,000 equity in each of them, your total risk of loss, because you put them in an LLC, is going to be $400K. They can't get more than what's inside of there. So you're down here and you're protected. But as I started investing, I realized that advice doesn't address the concerns of someone who's investing, trying to build a portfolio of residential real estate, because we don't buy for equity. That's a flip, right? In flippers, you're building the equity so you can turn around and sell it. If you're buying residential real estate, you're buying for what? You're buying for cash flow. That's what I buy for. I do flip, but I buy for cash flow. You can't live on your equity. So you're living on that cash flow. And so if I had 4 properties and each property generates $5,000 a year after all expenses, this LLC is kicking off $20K a year in positive cash flow. What I have put at risk is that cash flow. And that cash flow is what has allowed me to possibly change my standard of living. Maybe my wife's no longer having to work now because I got that $20K coming in. So a lot of the changes can happen in my life. And one screw up takes away all that cash flow. And so I tell people, I know how hard it is to build a portfolio. And, until you get that momentum going and things really start to take off, it's a grind to find deals, and especially deals at cash flow and the numbers work out. So I think when you're first starting out, I tell people 1 property per LLC. And some people will push back on me. I said, you're free to do it this way, but how difficult was it for you to get that first property, that second property, that third property? Do you really want to risk them? Because if something goes wrong in that LLC, they're all at risk. Now, there comes a point in time with your structuring where you can take on more risk. Now, as I stated, I have over 300 properties. I do not have 300 limited liability companies. But what I've done is I've compartmentalized my investments where I can put 10 properties per LLC. And the reason I feel comfortable doing that is because my properties generate really good cash flow, and I can take a hit and lose 10 properties. I had 2 properties burned down last year because of faulty wiring. Now, if that LLC was sued and I lost all 10 properties, it sucks because that maybe is $40,000, $50,000 a year now that I've just lost from my rental portfolio. But I have 29 other LLCs that are kicking off 50 grand a year. So it doesn't change my standard of living. It doesn't impact me the same way it would when somebody's starting out and they only have 5 properties and they become to rely upon that income and they're counting on that income to do their next deal and it's wiped out. Well, that's going to change significantly your lifestyle. So I think as you grow, you can afford to take on more risk. When you're green, you can't. And so that's why I've changed how we educate people on when you should create, one LLC versus multiple LLCs for your investing.
And would you have each of the LLCs have their own bank accounts, or you have like one common operating bank accounts and then for the different LLCs that you have?
Depends. If you're using a PM, then typically it's going to be one bank account for the group. So if I had like this, so take my in Indy, boom, they're all held like this. I have one bank account here. I don't have any bank accounts up here, but I keep good books and records down here. Now, why do I do that? Well, because I have a PM who will only send out one owner statement. So for 12 properties, they're not going to send me, 12 separate owner statements and 12 separate wires. They're just they send one wire and one owner statement with all 12 properties listed out. So I've chosen then to move it right into this entity here. So that's where it comes into. And then my bookkeeper steps in and then takes the owner statement and breaks everything out on my QuickBooks. Well, I actually ever do it on a spreadsheet for me because it's easier for me to read, and she puts it in QuickBooks. But then I can go on and I can check out each property on a monthly basis. I have other clients that self-manage, and if they're not using an entity that they've set up to be their self-manager in collecting the rents from the tenants, and then many times they'll have the rents paid directly to the LLC itself. And I also tell people, when you open up a bank account for an LLC, if you're really bad at books, right, keeping good books and records as far as from an accounting standpoint, you're better off just setting up a bank account for each LLC you set up and just collect all the rent in there, because at least you have the bank statements to go off of when you're preparing your tax returns. You can look back and say, all right, how much money did this property bring in? What were the expenses associated with this property? Because it's all running through that one account. So it's also a personality issue as well.
Got it. Yeah, no, great advice. Sue has a question. We hear that an LLC should have 2 members for extra protection. Is that true? And the second part of the question is, if the 2 members are married, is it the same protection?
Well, so what she's referring to is Florida, the Olmsted case that dealt with single member limited liability companies not having what we would call charging order protections. And so there's 2 forms of protections that you derive from an LLC. You have what is referred to as inside protection, okay? So what I've been referring to here, if you put a piece of property inside of a limited liability company, say this was Florida, and something goes wrong with this LLC, this is the only thing at risk. You are not going to be at risk unless you were the responsible party. Like, for example, you went out to the property and you did some electrical work and you were faulty when you brought the wires back to the box and you hooked them up wrong and the place burned down. Well, they'll sue you personally for that. Outside of your own negligence, the LLC will protect you. So all LLCs are uniform in this approach. Where they're not uniform is for what we call outside protection. Okay, so that is where you yourself are involved in some type of litigation that results in a judgment against you. Maybe it's a default on a lease. Maybe someone's suing you because of a contract, contract dispute. And so a judgment's entered against you, let's say in this example, for $500,000. So now the question becomes, what can that judgment creditor do with that judgment? Well, obviously, you're going to go fishing for the low-hanging fruit, which are savings accounts, bank accounts, brokerage accounts, anything that I can garnish. I'm going to try to do that first because the banks will pay me as your judgment creditor. That's why I said, get those assets out of your name. I look for equity in your personal residence, just record it. Then I just zapped your house. So any equity you have there, if you try to refi or sell, I'm going to get paid. So we don't want to keep our house in our own name either. So we try to minimize our footprint. Now, after they've exhausted all the low-hanging fruit, if they take you into a debtor's exam, they're going to want to find the stuff that's a little higher up in the tree that's going to require more effort for them to collect against it. Because generally speaking, you cannot take an LLC interest from a member. So I just can't go and take your LLC interest unless your state statute allows me to do that as your creditor. And that's referred to as a foreclosure action. They can foreclose on your LLC and take it from you. So In Florida, which is where a lot of this derives from, there was a decision that stated when this individual, Olmsted, was sued by the FTC and a judgment was entered against him for $2 million or five, I forget, maybe it was five. Because he had an LLC set up and he was the only member, the FTC could take his interest. They stated that LLC law in Florida did not protect single members. It was intended to protect a multi-member LLC, not a single member LLC. Now, if you read that opinion, those justices, they had their head in the sand. They don't even know what they were talking about. They didn't even call it a limited liability company. They called it a limited liability corporation, which explains, probably why they reached the decision they did. They didn't understand the distinction between an LLC and a company, but didn't matter. Florida came in, changed their statute, amended it up to say, hey, if it's a multi-member LLC, it's protected. Now that's from outside creditor. So when you're creating an LLC, if you came to me and you said, I want to set up a Florida limited liability company, I would tell you, hey, you got a problem with outside creditors. It's got to have at least 2 members, or otherwise, if you get sued personally, they can take it from you. So in certain states, we are mindful of that. Now, one solution you can you should implement is don't own a Florida LLC in your own name. Don't have it as a single member back to me as an individual. Stick it over here in a Wyoming LLC. In Wyoming, the law is very clear on this. It states that the sole and exclusive remedy available to a creditor of a member in a limited liability company, be it even if that is a single member LLC, so they even spelled it out, single member LLC, is a charging order, which you don't need to go into that, but essentially means they cannot take your interest. You still get to keep everything you have. So the 2-member LLC, I know people like to use that to generate fear in how you create your structures, and it's simple to fix. You just have to work around it. Be mindful of it, but you don't always have to set it up. Now, one last point I'll leave you with on this subject matter. When we set up a blue box like this, I will oftentimes recommend that this Wyoming LLC actually have 2 members associated with it, and we treat it as a partnership for federal tax purposes. And if you don't have a spouse or someone, well, if you had a business entity, you could make your other corporation, S Corp, a 1% member, as long as we have 2 members. And I do that not for asset protection, but I do it for tax reasons. I want my partnership LLC down here, that where all my real estate flows through, my investment real estate, to file a 1065. And the reason I'm doing this is twofold. Number one, I want to reduce your risk of audit, because if you have rental real estate, hopefully you're cost segging that property and accelerating the depreciation and trying to recoup as much as you can off the real estate. Maybe it's short-term rentals that you're dealing with, or maybe they're long-term, you're going for rep status. So all of that activity that we're running through there, I don't want it on my 1040 Schedule E page 1 because I'm at a higher audit risk. I want it pushed over to page 2 of my 1040 Schedule E, because rather than list out, for example, I met with a client in December. She said, Clint, can you take over my taxes? We file a tax return that's 120 pages long. I said, I imagine you have a lot of rental real estate. She said, yes. How did you know? Because you're filing a separate Schedule E for all those properties, and that's what's blowing up your return. How about if I eliminated that and you don't have to file a separate schedule for each property? We just have to file one line item. That's going to save you a ton of money, right? And it's going to make your tax return look cleaner, but more importantly, it'll reduce your risk of audit. And second of all, if you're buying and you're using qualified mortgage lenders, QM lenders, to put your deals together, and you're not using non-QM lenders, then you're going to look better to the lender and you're going to get a boost when it comes to your debt to income ratio. Because Freddie Fannie guidelines that the QM lenders operate under, they have to do a 25% holdback on your rental income. So when you're trying to fit in with that debt to income ratio, they're taking 25% of your rental income and saying, oh, that's for vacancies. We can't count that. But that only applies if you got the properties in your own name or through disregarded entities. When you just change it to a partnership, one tax change will boost it 25% on your income for borrowing purposes. So I know maybe it's complicated to what you've been hearing, and because I'm going kind of fast here, But this is when I said, hey, I got a three-legged stool, and this is the business planning component we're talking about here. Hey, I want to make sure your business keeps running and you don't have any disruptions because somebody's auditing you, or you're running up against debt limits and you can't borrow money any longer because of the way you're structured.
No, this is really, really helpful. I mean, I think as real estate investors, we sometimes tend to run into the, this mindset of, hey, let me just focus on making money now. I don't have the time or money to worry about the asset protection or, my tax entity structure for now. And you might not realize, like, you might be leaving a lot of money on the table, and you might be exposing yourself to, some lawsuit where you end up like, keeping everything at risk. So this is really, really fantastic information. Last question I'm going to ask you is, Ontavious has a question, and I've noticed some other states do this also. I invest in Indiana. I don't believe Indiana has this, but I know Illinois does. This thing called series LLC. What's your experience been with that? I haven't heard many investors use it, but I'm just curious, kind of what you have noticed in practice.
So, series LLC, for those of you who don't know what it is, it's just a straight up limited liability company with the added benefit that you can form cells, or separate series is how they're listed in the statute. I'm just going to call them cells, not to confuse anything. So this is your parent. This is what you file with the Secretary of State. Okay, so this is where you're paying your money to get the entity set up. Now, after it's set up, you can create these individual cells where maybe this agreement here is 100 pages long, spelling out all this information. These little guys are 3 to 6 page operating agreements that you set up. Well, and our clients will just call us up and say, Clint, I need a new cell. And we'll just draft a new cell agreement, send it out to them. They sign it. And now that is an entity that is eligible to take title to real estate. They didn't have to file it anywhere in most instances. You brought up Illinois. Illinois is one of those states where you have to record your cell in order for it to be a valid cell. But the majority of the states that have adopted this specific form of structure do not require you to record the cell. So when I need a new LLC, because that's what the cell is, it's basically a limited liability company for asset protection purposes. So you have properties in there and something goes wrong here, it's just that cell that's at risk. The other cells are protected. Whereas if you were in a state that didn't recognize this particular form, take Washington State, where I'm located. If I wanted to protect 3 separate rental properties, I need 3 separate LLCs. So that's 3 separate registered agent fees, 3 separate state filing fees. Whereas when I'm in Texas, I don't have that problem. They recognize the series. So I set up this entity, and then for each acquisition, I set up a new cell, and it saves me time, saves me expense to run the business. So who do I use this for? I use this structure for people who buy and hold in a series state and for individuals who flip. So if they're not using the land trust strategy, then we're creating a series LLC. This is, say it's in Texas. And then each flip, we put in a new cell, and all the cells are owned by that one series limited liability company. And then if they're buy and hold, because many times you have buy and hold and flippers, we do the exact same thing on their buy and hold side, just like this. And this one, we run down here into a blue box. We could do that here, but I would not stick it over here. I'd possibly consider doing a separate one. If you want the anonymity here and here, so people don't know, then don't tie them back to the same blue box down here. Keep them separate.
And you would do the same thing, like, what you were talking earlier a few minutes ago about capping it at certain equity or cash flow, depending on kind of what your risk tolerance is, even with the series LLC. You would do it at the series LLC level. I mean, the series, the parent LLC level.
Yeah. So here, what I would do, for the first 10 properties, I would have separate. I mean, really, you can just do as many as you want. If you have a series set up, what does it matter? Well, depends on who you're using for insurance. If I had a series LLC, I would probably set up 1 per property, because all I have to do is, it's like filling out a land trust. It's so simple to set up a cell. So that would be one area in which I would probably deviate from my normal structuring because of the simplicity of it, provided they don't have to be registered. Because again, if anything goes wrong, it's just that cell. You don't have to have bank accounts for the cells, nothing. It's just title holding only. So I would do it that way in a series state. And that's typically how our clients will do it, that buy property in a series state.
Awesome. Yeah, I didn't know about that. Yeah, and I should have guessed, like, if there's anything, any state that would make anything more difficult than it needs to be, Illinois would be right up there. So yeah, cool.
Yeah.
Awesome, Clint. Thank you so much for sharing this amazing, insightful information. So if people on this call, they want to get in touch with you, learn a little bit more about, how you can help them, like, what's the best way?
So here's what I would say. Every 2 weeks, I teach an asset protection event, a one-day event on a Saturday. It's from 9 to about 3:30, 4 o'clock in the afternoon, Pacific time. I would highly recommend, if you have the time, you could devote a Saturday to this. You come and you join myself. So in the morning, here's what we do. From 9 to around 12:30, I'm going to educate you on LLCs, corporations, land trusts, statutory trusts, series LLCs, how they apply to buy and hold, flipping, and wholesaling. Okay, I'm going to go through all that and show you how you should set it up. And I'll talk about anonymity, how to create it with anonymity, when you should use it, when you shouldn't use it. And then we'll take a short lunch break for 30 minutes. And in the afternoon, my partner, Toby Mathis, will come on and he will show you how to harness real estate to create massive tax deductions, how to use your business effectively to reduce your income taxes down. But here's what's key. He'll teach you from the standpoint of what types of deductions you should be taking versus those you should be avoiding, because he and I made this mistake early on in our careers. We went whole hog. I'm not going to pay a nickel in taxes, not a dime. I want zero taxable income. And we did it. We didn't pay any taxes. We can make $700,000 in a year, and I paid zero federal income tax. But here was the problem. When I had the opportunity to buy a commercial building and I was going to get an SBA loan and they asked me for my 1040, they looked at that and they said, "You make no money. You don't qualify. We will not loan you money." And so I trapped myself, and that stuck with me for 2 years because they wanted 2 years of tax returns. And so I realized, hey, there are good deductions and there are bad deductions. And you want to stick with the deductions, and good deductions are deductions that get added back into your income for tax report, for lending purposes. And so he'll break all that down for you and show you how you can use entities in real estate from just the tax angle to put more money back in your pocket. So it's bringing together both elements. It really encompasses what we do at Anderson. It's a phenomenal event. If you go to this link right here, you can register. There's no charge for you to register if you want to take advantage of it and come and educate yourself more.
Yeah, thank you so much, Clint. I dropped the link in the chat also, if anybody wants to just click on that link and bookmark it. And we'll also put it on our Facebook group and email the link out to everyone. And you said, Clint, this is every other week you guys do this?
Yeah, it's about every other week. There will be a few dates up there. Just depends on our travel schedule when we can.
Got it. Cool. Thank you so much, Clint. This was really great information. I mean, yeah, thank you for answering all the questions. And I understand, this is not always the sexiest topic real estate investors want to talk about, but, being an accountant, I used to be a CPA for Ernst & Young, so I totally understand the importance of it. And just looking back at kind of what I've done, it's such an important thing that sometimes people don't realize, by the time it's too late, or, like, oh, shoot, like you were mentioning that you lost kind of 2 years of, having zero federal tax, but then you need it for some other purposes. You're like, oh, I got to wait 2 years to have 2 years of tax return. So thank you for sharing all that information. And then we'll send the link out to everyone in our group. Raj has a question. Where and how do we find him when ready to engage him? So Clint, if you want to share your information, or if you send it to me, we'll email it out. But if there's an easier way for someone to get in touch with you, Raj has a question on, like, he might want to get in touch with you to engage you guys, as he's scaling his business. So just the best way to do is go to your website.
Yeah, just go to our website, andersonadvisors.com, and you can sign up for a free strategy session there.
Cool. right. I am going to put the link in the chat, guys. And again, we'll email this out so you can, go to the website and set up a session with them. All right. Thank you, Clint. Thank you so much for your time. I
Thanks for having
really,
me on.
really appreciate it. Thank you.